Okay, this is a marginal and absorption question from the 2006 paper. Um, so it's part B of a marginal costing question. At the bottom we're asked to prepare a profit and loss statement under marginal and absorption costing principles. Second part is just theory. Um, so the first thing we're going to do is going to do a marginal profit and loss statement, which is our marginal costing statement. How does it look? Well, it's sales less production costs. These are only a couple of different variable costs that we're going to look at first. Production cost is basically, we're starting with variable. So the costs that come with production. Production is to do with it increases the more you produce. These are variable direct materials, direct labour and variable overheads. The same as we normally would have in a marginal costing statement. After the variable we have closing stock. We'll get to that in a second. But we have our usual contribution, then you take away fixed costs, there are less fixed costs, and then we have profit. So we're just going to look at the marginal costing statement first because we already have seen this before. So they produce 8,000 units, 6,000 of these units were sold at €6. So I've sold 6,000 by 6, multiply the two together, I get 36,000 for sales. Direct materials is 50 per unit. It's 50 per unit that we produce. So I'm going to produce 8,000 and I produce them at 50 cent per unit. So 4,000 is going to be my direct materials. Again, I'm producing 8,000 units. I'm charging my labor at 80 cent per unit. So 80 cent multiplied by 8,000 going to give me 6,400 for direct labor. I'm just multiplying these here by the production amount, because these are all involved with producing. Variable overheads are 0.5 again, like direct materials, that's 4,000. If I add those up, it gives me 14,400. This is like a normal marginal costing statement. I'm just adding my variable. The only difference is now we're looking at closing stock. So what is closing stock? Well, if I produce 8,000 units, I make 8,000, but I only sell 6,000, I have 2,000 left over. That 2,000 is going into next year. Basically, the reason why we're taking away closing stock, because it's less, we're taking it away, is because some of the costs here are involved with producing items that we haven't used yet. They will presumably be sold next year. So we're going to take them out of the cost for this year and we'll charge the cost towards next year. Basically, we're not going to charge all 8,000. Instead, we're going to charge the full variable and then take away whatever we think was used for our closing stock. Closing stock is 2,000. It's 2,000 divided by the 8,000 we produce, which means 25% of all of my costs are going towards closing stock. 25%, 2,000, so I'll write it up here, 2,000, and if I was to divide that by 8,000, it would give me 25%. So that's 25%, that's after changing that there. So 25%, so that's the amount that my closing stock is. That 25%, if I then multiply my 14,400 by 25%, gives me this figure. So 3,600. So a quarter of 14,000 is 3,600. These are the costs that belong to our stock that we're going to use next year. So I'm taking away my closing stock, and that is going to give me, just black all these out here, 10,800. So 10,800 is my variable cost that applies to goods that I actually produced and sold this year. Contribution as of normal, we're taking away our variable costs from our sales. These are my contribution as of normal. In a marginal costing, we then go and take away our fixed costs, which are 3,000, and then to finish it off in profit, it is the fixed cost taken away from the contribution, 22,200. It's a normal setup. Sales less, these are basically variable costs. Only difference is I have closing stock. Closing stock is 25%, because that's how much of the units we produced that we didn't sell, 25% of them. So 25% of the variable costs will be transferred towards next year. Now, absorption is quite similar. The only difference is, if you can see it here, is that I've included fixed overheads up here before closing stock. So if you'll see the marginal costing, my fixed costs were included here, and my closing stock was calculated before that. I did not include my 3,000 here for a fixed when calculating closing stock. I'm going to do everything else the same. So I'll show you the first set of things here. My sales is calculated the same, 6 by 6,000. All of these here are multiplied by what I've produced to give me the exact same figures. This adds up to 14,400. But that's not my total, because I'm now going to include, for absorption, it's done in a different way. Fixed closing stock is calculated including fixed overheads. So the fixed overheads, as we see them here, are 3,000. I'm going to include that, and now I'm going to have my total. So my total is 17,400. That's my total for my costs, both fixed and variable. So absorption, we take closing stock from our fixed and variable costs together. 17,400, again, it's 25%, nothing else changes. 25% of 17,400 is now going to be 4,300. So if I take that away from this 17,400, it gives me 13,050. And then my last profit figure here is going to be the difference, 22,950. Again, the only difference is fixed cost was down here in a marginal costing statement, as we would normally do it. But for absorption, it comes ahead. Closing stock also comes into play, but as I said, it's just literally what's left over as a percentage of total what's produced, and you're just allocating that towards your cost.